What's going on, traders? Welcome back to my YouTube channel. So today's lesson, I'm going to be talking about 5 key points that you need to understand as a trader in order to find that consistency and profitability that you're working so hard towards. Now, did you know that in trading, there is no such thing as a bad trade? Now, some of you might turn your nose up at this and say, well, of course there is. Well, the way I like to see it is there is such thing as better trades, but not necessarily bad trades. And today I'm going to share 5 key points or tips that you can follow in order to start to change around the results that you're getting. Because the problem is in the industry that we're in, as far as I'm concerned, when it comes to social media and trading gurus, you'll find that there's so many misconceptions. There's a lot of deviation from the simplicity of what trading is really supposed to be. And I guess it's to attract up and coming traders, to entice them into believing that there is a so-called holy grail or a better strategy or a secret way to trade. Now, I've been trading for 10 years, and I'm going to be brutally honest with you. The concepts that were used 10 years ago, the concepts that were used by some of the most successful traders that have ever lived, are still the most successful concepts and strategies that are being traded today. Now, I know there's other variants and there's other ways to look at the market because everybody's perception is different. Absolutely. I'm not against it, but I'm definitely not 100% for it in the way that it's been portrayed. So today I'm going to really dig deep into into 5 key points, tips, whatever you want to call them, principles, ways to think about the market that you can start to apply in your trading almost immediately. It could be whether the markets are open or whether the markets are closed, or whether you're now going to spend the weekend thinking about what I'm about to tell you. But get out your pen and paper, because I can promise you it's going to be an absolutely epic video. If you're new to the channel, subscribe and welcome. Turn on notifications. And as I always say, please hit that like button for me if you enjoy the video. Without further ado, let's get into the show. Okay, traders. So we're over here now on USD JPY. This actually was a trade that was taken by one of my students this week. And I mean, we're going to talk about it because this is a very important thing that I want you to understand as you move forward next week into your trading, or whenever you decide to trade again after watching this video. What we have here is really nice structure. We can see from the upside here that we have strong bearish momentum. The trend is clearly moving to the downside. Granted, we did have the market stepping up for a period of time where we had this channel making higher highs and higher lows. And eventually we had the breakout of this channel back to the downside. So looking at what we see here, we have one area in the market where price was pushing bullish. We have one area here in the market where price was pushing bearish, and one area here in the market where price was pushing bearish. We have one bullish area, 2 bearish areas, and that means in theory, we're going to be focused on the bearish side of this structure. So now we have a structural high where price in theory never broke above. We have strong bearish sentiment. We have a break close below structure. We have a lower high and a new lower low. So the big question today is this. Price has made this new lower low. We have price stepping back into this really nice area of resistance where price once was holding. We had a breakout and a break back in, which is a sign of indecision. And now we have a really nice retest of this level where the bulls attempted to break back in through the structure. They failed. And now we have a really nice, strong bearish close. So the big question is, can we sell this market structure? Now, I want you to think about this for a few seconds, because this is not a trick question. What I'm going to be doing today is helping you to realize that there is no such thing as a bad trade. However, how you approach your trades is what matters. And after what you do about the result of your trade, in my opinion, is probably the most important thing, because trading is a numbers game. You execute, you either win, lose, or you break even. And the theory is you're supposed to do this over and over again. What makes it difficult is the fact that we're emotional creatures, and psychologically, we get affected by the outcome. So think about this just for a few seconds more. Is this a good entry? Well, in my opinion, this is a great entry. Now, as I said, there is no such thing as a bad trade, but there is such a thing as potentially a better way to approach your trades. But regardless, if you was to take this in the live markets, could you really scrutinize yourself for it? Could somebody judge you for taking this trade? If you were to take this trade 100 times over, what would be the results? I think you'd probably come out profitable. And I'm talking about 100 trades here, not free. So yes, I think this is a pretty decent trade. Let's see what happens. Okay, so we get stopped out. Now, at this stage, as a trader, you start to question whether you took the right entry. What you now start to do is you start to draw resistance levels. You start to say, well, did I take the trade at the right resistance in terms of using the 30-minute time frame? Did this really break and close below this structure? Did price really leave and make a retest? Was there enough wick rejection or indecision candles? And was the momentum strong enough to the downside? Should I have waited for price to break this structure and retest structure? These are all the excuses and or doubts that you're going to start to think about once you lose this trade. Because this trade loss doesn't make it any worse than it was when you decided to take the trade when it was a good trade. No, not at all. First and foremost, let me just tell you something. Whether you're new to trading or not, losses are inevitable. You're never going to avoid them. And if you try to avoid them, then guess what? You're going to fail. If you're going to come to me with a new concepts and principles that was developed in 2021 and tell me this wasn't a liquidity zone and this is where the buys are sitting, then whatever. The point is this. It wasn't a bad trade. But could we have approached this differently? Well, we're using the 30-minute time frame to identify a key level. And as I said, this was a trade that one of my students took. And then now I'm going to share with you a way you can approach this better. But don't let this discourage you. If you take this trade 100 times, I can almost guarantee you will make money because the structure falls in line with the bearish sentiment and the retest is there. Let me show you how we could approach this slightly differently. Using the 4H time frame now, what we can see here is a bearish sentiment, exactly what we gathered on the 30-minute time frame. Here we have a level in the market where price is broken to make a new low. The candle that we're looking at here in this stage is this candle here. The reason why we're looking at this is because this is where the shift in momentum happens. This is the behavior of the market today. What we anticipate when price breaks a structure in this formation is that price will eventually come back down to some of these structural lows. That is what price does. That is structure, and nobody can argue with me about that. Now, this is our original retest level. This is a level in the market where price is just broken. The lower the time frame you go, the more retest levels you're going to find. So one rule that I want you to follow if you're going to be trading or using higher time frames, remembering that this retest level wasn't incorrect based on the 30-minute time frame, but if you're going to use the higher time frames, is that the closer your entry is to a retest level, the higher the chance or probability of that trade working out in your favor. So now that we've marked the retest level on the 4-hour time frame, let's scale back to the 30 minutes. So now we're back to the 30 minutes. We anticipate price to come back down to some of these structural lows. Let's remove this level here and let's identify where the retest level where we took that sell. So we took a loss on this one. Again, not a bad trade. But now notice we have our 4-hour retest level. When you come down to the 30-minute time frame, this makes 0 sense to most traders. But let me tell you something. Based on higher time frame analysis, anything that happens down here on the 15-minute time frame is called noise. Based on current behavior, we want to focus on what's happening here. Based on higher time frame analysis, we want to focus on what's happening here, regardless of the noise that is happening here. Now, again, it doesn't mean that price needs to respect this structure, but let me tell you now what is a fact. You don't want to be the type of trader that starts to do things like this, adjust your levels to the 15-minute just to validate a trade. And you don't want to try and find the perfect resistance or support level in order to validate a trade, because it doesn't exist. What you need to do is, once you draw up on your higher timeframes, is make sure you focus on those levels and you don't deviate. So now price is pulling back. We know this is our retest level. That is a fact. And the structure of the market is indicating a bearish sentiment. What we need to wait for as a trader is sure signs that the market is respecting those key levels. And as you can see here, what do we have? Our previous retest level almost resembles exactly what's happened here, exactly what we're seeing here. But the difference is we have a higher probability key level because we're identifying this on the higher time frame. If we wanted to take this trade, would that be okay? Well, the answer is yes, because we see that price has made a new low. We see price has come back to a 4H key level. We're now starting to anticipate price creating a structural high, lower high. We have a strong bearish momentum candle. Now, the level that we're looking for price to come back to is this level here. How you judge your take profits is entirely up to you. This trade does push to around, I believe, 2 to 3R. But for this example, we're just going to highlight why higher time frame key levels are much more important than trading intraday key levels, especially when the focus is higher time frames. And as you can see here, we win this trade. Now, notice here, price came back into this level not once, but twice. But identify here, we have our stop loss above the last high that was made above the key level. And notice price respected that structure and continued the momentum off of the previous 4H candle, which was to the downside here, back to the level we anticipate price to react to next. So the point I'm trying to make here is this: the entry that we took previously here as a sell was not incorrect, but there is a better way to approach it by using higher time frame key levels. For me specifically, it's the 4H time frame, and look for the same patterns and behaviors so that you can have a much safer stop loss, avoid being stopped out, seeing the market go in your direction. Take into account that no matter what you see to the left is irrelevant, as long as the key level lines up with higher time frame key structures. And then also be aware of where you anticipate price to react to, so that you're not too greedy and trying to go for a 3R when in theory the range only allows you to have a 1R. So that's tip number one. Let's move on to tip number two. So here we're moving on to tip number two, and we're going to be looking at pound JPY on the 15-minute time frame. What we can identify here clearly is that the sentiment of the market is extremely bearish. We have a level in the market where price created a support, an intraday lower high, and a new lower low. We also have an area in the market where price came back for a retest, and we also have an area in the market where price has now created a double top formation. We have strong bullish momentum into this key level. We also then have a wick rejection to indicate a depletion, an attempt to break above, price failing, and a bearish candle close. Can we take this sell? Well, let's take a look. Of course we can. Now, what happens in a situation like this is traders get really caught up in a couple of things. The fact that the sentiment of the market is down, price has created a double top pattern, and we have wick rejections. And what they then try to do is try to hold this according to their plan. So let's say their plan says that the risk reward ratio that I'm going for is a 1 to 2, and or the risk reward ratio that I'm going for is a 1 to 3. Because based on my data, when I take double top patterns, there is a 67% chance that it will push to a 2R or 3R trade. That's completely fine. There's nothing wrong with that. And in theory, if you rely on the numbers and the data, then you should be holding your trades. One thing you cannot avoid, though, as a trader is what is happening on the charts. Even if you believe that price can come back down to some of these major structural lows, what you have to be very aware of in terms of being intraday trading is that intraday structural lows can be respected. It does not mean that price cannot break this structure, but what it does mean is that you have to be aware that price can react from this level. Now, our previous example, we illustrated that we don't really want to be taking trades from intraday levels, but it's okay to do so. And in our first example, we didn't win that trade from an intraday level. In fact, we got stopped out. Here again, this is not a bad trade, even though we're not using major key levels, because it's not wrong to take trades from an intraday levels. But what is wrong is to anticipate that price can break through intraday levels and that price will not respect those levels and eventually turn around and stop us out. So even if we think price can come back to a major level, and even if we think that intraday levels can be disregarded or broken, should I say, we still have to be aware of one thing. Price can still tap into them and price can still reverse. So in a scenario like this, does it make this a bad trade that we followed our plan, but it stopped us out? No. But what we can do in a scenario like this is we can identify that we do have a level here in the market where price can react from. And a rule of thumb that I advise most beginner traders is that when price pushes to around 1-to-1 risk to reward ratio, what you should be doing in theory is locking this trade in at break even. Because the truth of the matter is, if the markets are going to continue bearish, then they are. If price is going to respect that double top pattern and continue back down to a major structural low, then it is. But what you can't do is be the trader that hopes and prays that it will do that without managing that trade and making sure that you are fully aware that the area where price is reacting to is an area in the market where price is not broken yet. It does not mean there's going to be a full-blown reversal. It just means you need to be aware. So an intraday level sell is completely fine. Aiming for a major structural low is completely fine also because we anticipate the new lower low, but allowing the market to turn around and stop you out is not okay in a scenario like this. Lock it in at break even. If it goes down, it goes down. If it stops you out at break even, there's probably a very good reason for that. And just like you saw, we got stopped out. So be aware. This was not a bad trade, again, because it was an intraday level. It wasn't a bad trade because you anticipated it to come back down to a low and now price reversed and stopped you out. Even if you let it stop you out, again, it's not a bad trade, but be aware in situations like this with these kind of structures, sometimes it's better to be safe rather than sorry. Let's move on to tip number 3. So now we're taking a look at tip number 3, and we're going to be looking at Euro USD on the 5-minute time frame. Now, what we can see here on this time frame is that we had a level in the market where price was consolidating, and eventually we had a bullish breakout, a really nice intraday retest, and we've had this continuation to the upside. What we can see now is price is starting to respect the previous structural high. We have wick rejections, we have indecision candles, we have bullish closes. My big question to you right now is this: can we execute this trade? What I want you to think about while making this decision is this: the sentiment of the market is bullish. Price is broken above this structural high for the first time in a long time. We have really strong bullish engulfing candles here to help illustrate or identify volume and momentum. We also have wick rejections to identify depletion in bearish sentiment. Is it wrong to take this trade? If you answered no, then you would be correct. If you answered yes for different reasons, other than the fact that this is not a bad trade and all the signs there for it to go up is there, then I'm with you as well. There's something that we have to consider when taking trades like this. Most of you out there are looking to take these trades in anticipation of one thing, that the market will continue bullish. In the long run, over 100 trades, 200, 500 trades, if you trade like this, it's not incorrect, because in theory, if the momentum is going to continue bullish, then that's what it would do. But what happens in most situations like this is you'll start to see the market pushing your direction, and then eventually you'll get stopped out before seeing the market go in your direction. Now, why is this? Well, that's the way structure forms. price likes to make push phases. It also likes to exhaust to make higher lows before then continuing higher. So does this make this a bad trade? Again, no, because the signs are there that it can continue bullish. And in some instances, it will just fly up. You'll miss the trade. And then we start to, find ourselves in a cycle of FOMO. But as a rule of thumb, if you want to avoid situations like this, there's two things you can do. You either wait for price to create an identifier mark that the higher low or lower high has been formed, and then you look to take the shift above the previous high, and or you make sure you place your stop loss in one or two places. If you don't identify the higher low, then where you're looking to place your stop loss is below a key level. And if you have that in the back of your mind every time you plan to take a trade, I can assure you traders, even though you may not be getting a 2R, a 3R, or a 5R trade, what you will be guaranteeing yourself in most situations, and I say that very lightly, but I also am very adamant about it, you will more than likely in most situations guarantee yourself a result. Now, in my mind, it's better to make money than it is to lose money and try to make money back. Do you understand? That happens in trading, but put yourself in a position where you can almost guarantee yourself a positive result. Whether you make 1,000, 10,000 or 100,000, the point is we're all here to make money. So the rule of thumb is this: have your stop loss always below what you perceive to be a clearly identified higher low or lower high and or key level. It is that simple, because when you do, even if price pulls back on you and the sentiment of the market is bullish, there is a very high chance that it will continue bullish. What you don't want to do is try to cheat the markets too often that you find yourself in a position where you get stopped out and then you see the markets going your direction. So was this a bad trade? Absolutely not. Again, over about 100 trades, this probably will prove to be profitable, because then you increase your risk reward ratio. And when it comes to risk reward ratio, in my humble opinion, it is the holy grail of trading. Nothing else but risk reward ratio. And that is the advantage that we have when it comes to the numbers and the probabilities. It's that simple. So think about it. Make sure you got your stop loss in a safe place below a key level, high, low, lower, high, to ensure that if you are completely right in the direction, you give yourself the highest chance of succeeding and winning that trade. Let's move on to tip number 4. So moving on to tip number 4 here, we're taking a look at Aussie dollar USD on the 1 hour time frame. So we can see with this structure, we have a trend line break here for the first time in a very long time. We also have an area in the market where price is broken below the last higher low. We create a new lower high, a new lower low, and now we create a double top pattern here. And we've mentioned it as a reversal because in theory, the structure still hasn't created a new low to identify a structural low, lower high, lower low formation. But what we can anticipate here based on the double top pattern is that there's a very high chance price will continue bearish. Now think back to I think it was the second tip we were thinking about here. What we have to always be aware of is our majors in the market. And if price is respecting those majors, then in theory, we have to be aware of one thing. That is where price can react from. So how do we identify this as our major? Well, it may not be our major because you might be saying, well, wasn't this your major? Isn't this your major? Isn't this your major? Why is this now your major? Well, I think you can see clearly from this higher low, this is the first higher low that created this high. Once price broke above this area of noise, made the new structural bullish sentiment and structural high, this was the higher low that made this high. When price came back to this level, we tapped into it twice and we've respected it, and we have moved sharply to the upside. Here we tapped in, but we didn't move sharply to the upside. So now we know this is an area of interest for buyers. With that in the back of our mind, my question to you is this: can we sell this structure right now? If the sentiment of the market hasn't fully reversed, can we sell it? Well, look, Some might argue yes, some might argue no, but I just want to give you something to think about. If you get into a reversal phase at the earliest sign with enough confluence and evidence, guess what's going to happen? You're going to find yourself in some really good trades. Now, I'm not talking about being the guy or the girl that guesses where the reversal is going to happen. I'm talking about identifying clearly that we have a trend line break, that we have a double top pattern. We have 3 hours of bearish movement to the downside with strong volume and momentum. And we've also identified where we know price can come back to before it reacts from. Why not take the trade? We have the confluences, we have the evidence, we have the confirmation. If we're right, guess what? We're going to make a lot of money. And if we're wrong, we take a loss as part of trading. But we're also not silly, or we're not going to disregard, should I say, the fact that price can react from here. So as much as we'd like to be the person that gets into a 1-to-5 risk reward ratio trade because it's going to come all the way back here for some reason, we're still happy to settle for, let's say, a 2R trade. So let's see what happens. We take the trade and we smash take profit. Now look, as price comes back into this key level, we have a reaction, a very aggressive reaction. This is normal. Does this mean price can't continue down? Of course it can. But should we be the guy or girl that anticipates that it's going to continue down without confirmation? No, because in theory, until price does this, then the sentiment of the market is still what? It's still bullish. And how do we know that? Again, what we want to be making sure that we're focusing on here is what is happening on our higher time frames. As you can see, the trend of the market is bullish. If we remove this black line, we remove what I said about a trend line break, and we get rid of the double top reversal and the new lower lower high trend line, what do we have? We have a bullish structure market with the last higher low, price respected, and price is tapping into. So was this trade a bad trade if the sentiment and structure of the market is bullish? No, it wasn't, because we were fully aware that price can come back to the last higher low in the higher time frame uptrend and respect it. So we were satisfied with a 1-to-2 trade. So what happens in a scenario like this? Well, let's go back to the hourly time frame. We take profit on this one. We know now that we've taken this trade in a buy bias trend on the 4H time frame, but it doesn't make it a bad trade because we had the confluences there that lined up to take the trade. So we take our profit. So my big question to you is this: can we buy this market structure now, knowing what we know on the 4H time frame, if we've just taken sells? Well, of course we can. Because now what we're starting to see in this market structure is that price is respecting the 4H higher low, price is failing to break this structure, and now we're starting to see signs of bullish behavior. We're taking a trade at a major key level in the market where we can tuck our stop loss behind the last low. If price starts to break the structure, then guess what? In theory, we are royally wrong. But if we take this trade, in theory, it's completely fine to do so. Why? Because the higher time frames illustrate that the trend in the market is up. We also see strong bearish depletion. We see bullish momentum, and that now warrants us to take this trade. And as you can see here, we eventually hit take profit. But again, notice in this scenario that we're not going to try and run for the home run here, because we know that price can react to the key level. So in order to go for that home run, you either lock this in at break even, or you wait for the shift, which is this range in market, to change from being in a range now, because we have 1 tap, 2 tap, 1 tap, 2 taps in the sequence, because this is disregarded as previous behavior. And what we wait for is the break retest, and then we look to get in a trade, because now we have a continuation of an intraday trend. We would then also have a break from a higher time frame perspective, which is a new shift in momentum, and then to anticipate a new higher high. Balance your greed factor. No trade is a bad trade. There are ways to take trades and manage trades, but balance your greed factor. Home runs will come when you are not expecting them. But don't run for glory every single time, because you find yourself in big trouble, either losing your trades, giving back profits, and or just finding yourself, as I like to call it, in a cycle of doom where you're just playing the guessing game. Let's move on to our fifth and final tip. For our fifth and final tip here today, we're going to be looking at pound USD on the 1 minute time frame. Now, this is called a deep pullback trade into a level in the market where price has created a very strong shift, either to the downside or to the upside. Now, why is this level important? Well, there's going to be many theories out there, and I'm not discounting them, but most will say these are liquidity areas. These are where the orders are sitting. This is where institutions are looking to trap retail traders and whatever else those theories are. Again, I'm not arguing that somebody may not be right, but what I'm saying is when you keep it simple and you follow the process that we've already understood up until now with those last 4 tips, you find yourself, or you position yourself in a much better place to find that consistency and profitability that you're looking for. Because if you notice, we haven't spoken much about anything complicated other than common sense and identifying how structure moves. So the big question here on this final example is this: is this a bad trade? In my humble opinion, based on the fact that we know this is where the market had a very sharp reaction from before, we have strong bullish momentum coming back into this level here that is now being created as a deep pullback, and we have a strong bearish candle to the downside. I don't think this is a bad trade at all. Now, if we take this trade and we're correct that the market will react from this level, based on past history, which is this behavior here, there's a very high chance that price can now correct this movement to the upside back to the downside. Now, please understand something. We're on the 1 minute time frame here, so we're only taking advantage of moves based on a single 30-minute candle and or a single 1 hour candle and or a single 4 hour candle. So we're not asking for much to happen other than for a candle to move in our direction. Please understand that. So if we take this trade, look at our risk to reward, pretty decent. What we are doing though is we're going against the current behavior. We are putting our hopes, I guess, or our idea, trading idea based on the reaction that we've seen happen before in the past, which is the sharp movement down. We have confluences to validate this trade. So let's take it, because if we're right, we're going to make some serious money here. And as you see, we have a reaction and we have a continuation of that reaction. Now, the problem is traders are going to be completely satisfied with this move because they was not incorrect that the market cannot react from this move here. When the market starts to push bearish, you start to build hopes and you get really wrapped up in the idea that you're now going to hit a 1 to 4 trade. And if you do, then you're going to be so much closer to your goals. You're going to make X amount of money and you're going to be able to do so much more. And you found the Holy Grail and blah, 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 blah. What eventually happens in the long run is you find yourself in situations like this when taking these trades. Now, this is fine, of course, because we were completely right that price can react from this level. And we now accept that the market has stopped us out. So it wasn't a bad trade. It just didn't work in our favor. What becomes a very big problem here now, traders, is when you start to do things like this. You start scrolling back to the left and you now try to latch on to anything that you possibly can because you're now discouraged that this trade didn't work out in your favor, and you continue to chase the reversal in the market. And as you can see, we now have a reaction from this key level, and now our risk reward ratio increases. What happens in this situation is you start to build hopes and dreams again that the market's going to continue in your direction. And as it does react from that level, you start to get excited. What happens? You get stopped out. Now, by this stage, it's almost game over. because what you're now doing is you're focusing your attention on what can be a reversal to try and claw back now the 2R that you're down and chase the 5R that could have been. So you continue to wait for any sign that you can possibly get from the market to take a trade. And then guess what eventually happens? You find yourself chasing the markets. So we have another bearish close here. What do traders do? Let's remove this level. No, let's keep that level actually. What do traders do? They now draw themselves a resistance level. Stop loss above, and they convince themselves that this is most definitely the last high where price is going to reverse from, and then they take the trade. Risk reward ratio increases. I can get back my 2R losses here, and I can now be up 6R if I win this trade. Price reacts from this level. They hold and hold and hold and hold and hold. And eventually what happens? You get stopped out. Now you're down 3R because of one simple thing. You had a high probability setup based on previous history. You had the behavior to support why you'll be taking a trade. You also have a pattern that has a very high probability of winning. What you didn't do is what most traders find themselves stuck in forever in their trading careers, is you didn't accept the loss and walk away. You chase the loss and you continue to chase the loss. And this is a scenario that most traders find themselves in, and the number one reason why they never become consistent and profitable. So our first trade was not a bad trade. What becomes very bad is the behaviors that come after this. And that's the chasing and the seeking to make sure that you can recoup your losses, to validate that you're a good trader, and to make as much profits as you can, because now you find yourself in a position that you don't want to be in. That simple. It's that simple. So think about it, traders. I hope those 5 tips were of use to you. As far as I'm concerned, what I'm sharing with you here now is of the utmost value. And all I ask from you guys and ladies is just to hit that like button for me. Subscribe if you're new to the channel. Turn on notifications for when I next post a video. And I just want to continue to say to you all, continue to trust the process.